The Love of Money Talk Show. I'm your host Emilio Camara, and we're here 98.1 Pearl FM Radio. We're actually recording. We are actually recording via the Skype. So this is a new setup for us, and we are abiding by social distancing and so forth. So we using technology to the fullest capacity. So this is a new environment, and so new environment presents new opportunities as well. So don't leave the virus knock us down, but also make use of the opportunities that are out there. I would say our one biggest limitation is, of course, the internet speed could be a bit better, of course. It's unstable and so forth, and there are so many different products and services that we can offer, but we need to get our internet on a strong peak if we really want to have a small, vibrant St. Martin that is could withstand different types of economic shocks and so forth, because these type of pandemics, economic shocks and so forth are the norm. It's nothing new. Is if you look at history, it repeats over and over and over again. And so we need to actually also be aware of this. And today, before I go ahead, though, we have, of course, some news that the government building will be closed tomorrow. I guess they are actually going to fumigate, as there has been some, you know, the COVID-19 has been, spreading itself all over the place. So as a precaution, they're going to be fumigating the government building, and so they'll be back and kicking on Monday in full swing. Um, Fortunately, there is we're under tropical storm watch. So tropical depression number 13 expected to become a storm, and so this was released by DCOM. It says that Great Bay, St. Martin, as of 11 a.m. on Thursday morning, St. Martin is on the tropical storm watch due to the formation of tropical depression number 13, which as of 11 a.m. is located approximately 750 miles east-southeast of the country. So it's projected to be a tropical storm, and so it might strengthen within another 48 hours. And so these are we're getting into the peak of the hurricane season, so we have to be vigilant. So what I'm going to do, I'm going to continue with my presentation before I get into that video I didn't get to show you last week. I was supposed to have a guest today, but I kind of sent him the discussion points and thing a bit late, so he probably will come on next week, if not the week after. It's a treat because he'll be talking from Holland. He's actually living in Holland for a number of years, a good friend of mine, and so that will be some good discussion points, with his experiences in Holland, having been there that long, and he can also show us some of the trends and so forth in Holland. But what I'm going to do now, I'm going to share my screen so we can continue discussion before we get into that video today, which is actually a war on cash. The video we'll be talking about. So let's get into the share screen option, and so let's continue this presentation. Okay. Let me see here now. Okay, so we was talking about the money creation aspect in the last video. So we're gonna do a short recap and then get straight into the points I want to make today. I mentioned this the last time. It says the process by which banks create money is so simple that the mind is repelled. This was said by Kenneth Galbraith. Another interesting one is claimed to have been said by Henry Ford, but there's different TV saying he didn't say it and some saying he did say it. Nonetheless, it said that it is well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning. Now, I like to show this picture. It shows money and credit, because money plus credit actually helps to engage in total spending. So you can actually spend money in two different forms. You can spend it as money, or you can spend it as credit. You also have deposit, bank deposit notes as well, and so forth, which is a form of credit, so to speak. But nonetheless, money, keeping it very simple, money plus credit can equal total spending. And I showed how this money creation came about in the last program. I'll briefly recap, very briefly on this. In this particular chart, you've seen that the blue line I mentioned, even in St. Martin, I showed you the St. Martin case as well, where the physical currency represents the blue line in the case of America, and then the red line represents the M2 money supply, which includes physical money. But as you can see, as M1 and currency are actually, going up steadily, the red line is growing exponentially, which includes bank deposits and so forth. So this exponential growth, it's a problem, and you will notice that in another chart lower down, the debt growth is a similar trend. So when you analyze it further, you realize that the creation of money and debt is the same thing. So debt equals money, money equals debt. Now I mentioned in the commercial bank example, I'm going to go to the one of the last part of the examples. So in this last part, we saw that the money supply had went up to 230. We had 230 currency, 230 money supply. In this case, deposits, and we saw that the depositor account number one, that was the initial gentleman or woman who deposited the $100 into the banking system, and then in this case, we reached to a point where there was two loans that went on the books, and so when the loan went on the books, the bank creates an asset and a liability at the same time. So the double booking entry, accountant entry always means that you have to create a debit and a credit at the same time. So in this case, when the bank created the loan, it becomes an asset in the books for them. So they debit the assets and they credit the customer's liability account. In this case, deposit account. And we saw the first loan was 50, and the deposit account is 50 on the other side. And for the loan, the second person that came for the loan came for the $80 loan. And as soon as they do the entry, you get a debit and a credit, and you see that on both sides the increase. But there was no movement in the reserve, neither the cash or the reserves by the central bank. They actually total back to 100, which was initial depositors' money. But from that depositors' money, you saw that additional loans came about, and that loans also means credit money was created. And in this case, one for 50, one for 80. And so you have 130 in credit versus $100 in physical money over here. Okay, so money plus credit equals total spending. Now the problem we saw that is that when more credit comes about, when you issue credit in a wrong manner, you get more increasing credit money, and that tends to increase the money supply, and then also it actually tends to push up the cost of living if more goods and services does not come about at that same rate. And usually what should happen is when you issue money incorrectly into the economy, you have to actually try to have redemption. So there's the issuance and the redemption. Redemption means when you're paying back the actual loan and so forth. So if money is issued inaccurately into the economy, it tends to grow. And to remedy that, you have to then make sure that the redemption increases as well, to lower that money supply, which generally never happens or usually never happens. It continues until, of course, you get a bust, and then you get a recession, then a depression. And that has been shown throughout the whole centuries or whatever to be the same philosophy. And we know the bottlenecks of this system. Of course, that's not taught in school, of course, but we know, and people know of this bottleneck. Even the founding fathers of America know the bottleneck of this system, but yet a small few seems to have this system on the lock, and continuance is a structured path for years and years and years. Okay, so now the next slide was, we saw that the depositor one decided to withdraw $77 in cash. Okay, so from his deposit account now, he wants to withdraw cash, and we saw that the bank only had 77 in cash, $23 in reserve by the central bank. So when he withdrew the 77, the bank no longer have cash. There are reserves by the central bank of 23. The money supply then dropped down to 153, and that consisted of the person's balance when he draw the 77 from his $100 account that was there before. So when he withdrew 77, the deposit account went down to 23. We saw that the deposit account number two from who got the loan of 50, he didn't spend it as yet, so it's still there. And also the person who got the $80 loan didn't spend his money as yet, so it's still on his account. So 23 plus 50 plus 80 represents the 153 on the right side of the bank balance sheet of the bank. And then on the left side, they have the reserve, the loan asset number 1 for 50, loan asset number 2 for 80, and the balance, of course, balances on both sides. Now we're gonna do another scenario. Okay, this was the reserve requirement, so I don't need to show you that because this was just reserving the 153 in deposits, 10% of that. So let's skip that for a bit. Now I'm going to show you a repayment of a loan and interest, and you're going to see what's going to happen here from the last situation. We see that the deposit account for the deposit number 1 is still 23 after he withdrew his 77. Deposit account number 2 is 0. What happens here? He didn't need the money again. At that time, interest accrue on the debt, of course, but nonetheless, he was able to repay back the loan. So when he did that, there's a debit and a credit. In this case, the bank will credit the loan asset to zero it out, and the debit the deposit account from the person to zero that out. At the same time, interest is owed. In this case, interest of $3 is owed. So what had happened here is that the interest profit will be 3 on the right side of the books from the bank, so that represents their profit, and at the same time $3 in cash went over to the bank to increase their cash balance. And so when the loan was paid back, we saw that the balance went back to 106. What you see here though is that the loan that was created and the deposit that was created is actually zeroed out. So that money, once money is created out of sort of thin air, when it's repaid, it actually zeroes out. What remains only is the interest portion. So that interest has to be repaid from some funds that are within the economy, and so that person had to find that $3 somewhere in order to pay that interest back to the bank. But the loan is zeroed out, so that money now or credit is no longer available to further stimulate the economy. If it was based on, of course, physical money, that physical money would have remained, which you will see in a bit in the case of a savings bank like Postbal Bank. But you have to realize that when money is created like a 10-year, when it's repaid, it also disappears. And that's part of the problem. So as persons pay down their credit debt, credit loans and so forth, that money disappears and it cannot be reshuffled to be used to further boost the economy. So that's one of the problematic areas of credit creation as well. Now in this case, okay, so this was a reserve requirement, because now the bank deposits has dropped, so of course less money is needed in reserve. So this was just reserving and put them back, the SX reserves back into the cash. So this was this aspect, so nothing major there. Let's look at the savings and mortgage bank. Let's recap that. We saw the one saver came with $100 deposited into the mortgage bank. Cash went up on the left side, savings account on the right side, and so 100 is balanced on both sides. So this was the reserve like we saw the last time. And let's go back now. In this case, somebody came for a loan. In this case, they want $50. And you saw that there was no debit and credit on both sides, but the debit and credit actually only happened on the left side of the balance sheet. In this case, the cash dropped by 50 and the loan asset went up by 50. So there was no new money created. It was existing money reshuffling. And so there was no new money created because the balance on both sides remained at 100. Somebody else came for a loan. In this case, $40 loan, and now you see that even though the person came for a loan, the balance on the both sides is still 100, because what happens is the remaining cash of the 40 now went to this client as a loan, so the bank doesn't have any more cash. They have reserves of 10, but they cannot use this because they have to meet the reserve requirement of 10% of the savings account deposits, which was 100. So 10% of 100 is 10. So in this case, if no other person came and deposited savings in this bank, or no one repaid the loan, this bank will be stuck for a while and won't be able to create actually issue no more new loans. So you can see that a bank that reshuffles existing money works up totally different than a commercial bank that can do both. Now, let's say the person repaid the debt, and now they repaid the debt, which was let's go back. So it was 1540. So the person with a $50 loan decides to repay the loan, and as soon as you repay the loan, you realize that the loan asset is zero out. However, the money gone into the cash, in this case of the mortgage bank, let's call it Postpad Bank. So now there's $53 remaining now that can actually be lent out again, and so forth. And that interest occurred. He paid interest of 3, which goes on the right side of the balance sheet of the bank in terms of the profit, and that 3 goes back into the cash, and the loan is zeroed out. But of course, cash comes back, so that money can be reused again to reshuffle like a revolving fund. Whereas with a commercial bank, that's not the case. When the person repay the money disappears. Whereas with a Postbank bank, the existing money comes back into being that can be used again and again and again. Okay. Now you need to understand that back in the days, knowing our founding fathers of America and so forth, they understood the system very well, and that's why they had created something called the Glass-Steagall Act. Now, in 1933, in the wake of the 1929 stock market crash and during a nationwide commercial bank failure and the Great Depression, 2 members of Congress introduced an act known today as the Glass-Steagall Act that would separate investment and commercial banking activities. So in actuality, back in the day, so after 1933, this act separated commercial activities from, so a mortgage bank would be separate from a commercial bank. So a commercial bank could not do certain things that a mortgage bank could do. They separated the 2 functions. And they did that because of commingling, and that caused a number of problems. So the Glass-Steagall Act was passed in 1933. So some key takeaways of the Glass-Steagall Act was that it was passed in 1933, and it actually separated investment and commercial banking activities in response to the commercial bank involvement in stock market investments. This mixing of commercial and investment banking was considered to be too risky and speculative, and widely considered to be a culprit that led to the Great Depression. Banks were thus given the mandate to choose either commercial banking or investment banking, so they could not do both. However, an exception allowed commercial banks to underwrite government issue bonds, which is a problem by itself, but I'm not going to get into that right now. And then the Gramm-Leach-Bliley Act eliminated the Glass-Steagall Act's restrictions against affiliations between commercial and investment banks in 1999, which some argue set up the 2008 financial crisis. So almost 70 years after the Glass-Steagall Act was enacted, and in the wake of many changes in the structure of banking and financial services, more generally, the legislation was repealed. So the Glass-Steagall Act was repealed by the Gramm-Leach-Bliley Act, which was actually signed into law by President Bill Clinton on November 12, 1999. And then in the link below, you can actually check out the link below to read more about this Glass-Steagall Act. But you can see that things was actually put in place knowing the shortcomings of our system, and everything has shortcomings. I love flying, and if you try to take off in a single engine propeller aircraft, even a twin engine, depending if it's not counter rotating props, if you try to take off, you get this left turning tendency, which can be annoying, especially with a high powered engine, and that's just a reality of physics. And so we have to account for that. And some builders build the aircraft in such a way to limit that left turning tendency. So there are always shortcomings to certain systems. So knowing this, the 4 founding fathers put certain things in place to prevent it. What happened? It was repealed by Bill Clinton on November 12, 1999. Of course, he got pressure and so forth, and you know how the story go. And he repealed it, meaning that they was able to come back together again to do the same destruction they was accustomed of doing. It's a pity. So of course you see now that this red line, this is the money supply, in this case United States money supply, deposit is growing exponentially. At the same time, if you look at the debt, this red line, similar, is the total American debt. As per 2016, it was over 70 trillion in federal, state, local government plus federal debt to trusts and so forth, businesses plus household, was over 70 trillion and climbing, and the national incomes was actually flat, barely growing. The total American debt actually went exponential, similar to the money supply going exponential. So how ironic that these this line is almost exactly same trend as the debt line. So therefore, you can conclude that money and debt is actually the same thing nowadays. Now, you need to understand that one of the biggest problems when we talk about inflation, inflation is caused by a number of things, but the biggest culprit is the improper issuance of money into the economy via commercial banks. Now, what is the proper basis upon which money should be issued? Now, money should be created on the basis of goods and services that are already in the market or shorted to arrive there. This is based on something called the real bills doctrine in economy. The finance function has need of long-term credit that enables capital formation. For example, it provides the means by which production capability can be renewed or increased. So, in other words, an improper basis is any loan that does not put goods or services into the market either immediately or in the very near term. So, I say near term, I would say within a year maximum. And so banks commonly create deposits, which is money, by making loans to finance both flow of goods and services into the market, as well as making loans that take them out of the market. So you need to understand that if someone is gonna put something into the market, so someone who's a developer, someone that is a producer, is if he's gonna put something in the market or whatever, then you can create new money for that because it's very productive. This person is creating products that are going to get into the economy in a short term and to able to people to buy. So in that case, the rule is that then you can create new money. But if someone is just going to take a loan to take out something, so there's no production or whatever, anything like that, so there's mostly consumption nature, then existing money should be reshuffled. Should not create new money for such aspects. And if you create too much of if you create money improperly into the economy and it's too much, and if it's in excess, it says that if too much improper issuance occurs, the rate of issuance should be slowed to match the rate of the redemption. So in other words, if you create money into the economy in a wrong manner, you have to slow the issuance of that, slow the rate of that, and try to make sure that loans get repaid so that you have acceptable level. So you have to match the issuance and the redemption at the same time. It's almost like in an aircraft when you pressurize in the cabin. You have an outflow of air and an inflow of air. You close off the valve to pressurize the cabin and so forth. That's very meticulous. So you have to monitor that rate and so forth. So the same thing applies when it comes to overissuance of money into the economy in a wrong manner. So when a bank makes a loan for the purpose of financing consumer purchases, that's the take option. Because if I'm gonna buy for example, a car or furniture or whatever, I'm just taking out of the economy. I'm not putting anything back. So that's the take aspect I'm referring to. So when a bank makes a loan for the purpose of financing consumer purchases, or for investment in long-term productive assets, those newly created deposits are inflationary because they deliver goods and services to the marketplace only in the distant future or not at all. Improper basis of issue then include the purchase by banks of government bonds in excess of time deposits held by savers, as well as loans that finance market speculation. So if you see that's happening big time in America, so the Fed is actually creating debt to monetize bonds and so forth, but there's no new services and products actually coming about at the same rate. So what you get is speculation and so forth, and so you're having a improper issuance of money in that sense. Then also the applicable principle in this case is that long-term uses of credit should be matched to long-term sources of credit. The logical conclusion is that investment should be matched to savings. New money should not be created to finance capital formation. Why? Because money creation should be matched to goods and services that are in the market now or on the way to market. But capital investment deliver goods and services to market later. If more money is put into the economy but more goods are not, the value of a currency will be diluted. On the legal tender, that shows up as rise in prices. Okay, so I'm almost wrapping this up. We're getting ready to play the first video, which will be War on Cash. So I'm gonna just finish off now. And so it says, in practice today, these are just principles that should be adhered to, founding principles. But of course, in practice today, these principles are commonly violated by banks. Banks provide both functions by making loans and make little distinction between them. And so that's the problem. So they're the same principle as money and credit. So although money and credit can be used for spending, they are totally different. They have different characteristics and so forth. And so you have to understand the difference. Even though they can buy the same thing, they're not actually the same. They're not actually the same. So to recap, I made a little table from Thomas Greco. He said that there are two distinct kinds of credit, and he says if the duration is short term, then the exchange credit should be used. In this term, you can create new money for that. If the duration is long term, then you should use finance credit. In other words, savers, time deposits, and so forth, so existing money. If the purpose for exchange credit is to facilitate exchange, and the purpose of finance credit is to fund capital development, which takes a longer time to happen. So therefore, you should use existing money for that and not create new money for something that's not going to come to market anytime soon. Relationship to money. So the exchange credit means that it's newly created money, and finance credit is actually reallocation of existing money from savers to entrepreneurs. Now, by having both functions in a bank, it can be kind of difficult to distinguish between the two. That's why the Glass-Steagall Act had actually separated the two. You could not have been both. And so if you look at Postbat Bank is purely a mortgage and savings bank. Although they do personal loans and so forth, that's a very small portion of their portfolio. I would hope so. But nonetheless, they reshuffle existing money mainly because you cannot go to Postbat Bank, for example, and open a current account, checking account, and none of those things. It's just a savings account or time deposit. So there you see that the existing money gets reshuffled. So now we're gonna play the video that I was not able to show last week, which is called the war on cash. Okay, so let me just unshare my screen here so you can get the video going. So this video is war on cash.
There have been 3 monetary shocks this century, each one devastating to the people that are holding money. And in this video, I'm going to go over what I see as the 4th monetary shock. We're going to look at what this means, how bad it can get, how fast it's happening, and of course, what we should be watching and we should be doing. So stay tuned. All right, welcome back to the channel. My name is Mark Moss. I believe that the only security we have in life is for us to take responsibility for ourselves. The system is broken. No one's going to come and save you. This is why you must learn to make money, grow money, and protect money on your own. Now, if you agree and you want to hear more about those types of topics, then click on the like button right now and then hit the subscribe button, hit the bell notification so you're notified every time I put a new video out. All right, so today we are talking about a 4th great monetary shock that's on its way. Like I said, 3 in the last century, and the 4th one is happening right now. So let me ask you a question. Do these dates ring a bell for you? 1907, 1933, 1971 maybe? Now, to most people, these dates probably won't mean very much, but if you've been watching this channel, if you've been watching my channel following along for a while, then most likely you know what those dates mean. If you are one of the people that know what those dates are, then you probably know that those dates are the dates that we had previous monetary shocks. These monetary shocks are really resets or maybe even complete changes to the entire monetary system. And not just for the United States, but for the entire international monetary system. And so, I talk a lot about the dollar, but it always has implications for the entire world, and today we're going to talk about that. Now, each one of these panics, each one of these shocks had major impacts to both savers and investors. And as big as all 3 of those dates were, we're sitting on the edge of a 4th one. We're sitting on the edge of a 4th shock, and I think this final shock is going to obliterate all financial privacy and put all your savings in dollars at risk, no matter which currency you hold them in. Now, again, if you're one of the regular viewers of this channel, this might not be such a surprise, but for most, they will be completely caught off guard. And even if you do know what I'm talking about, have you made the needed adjustments? Have you positioned yourself to be safe and, better yet, to profit as these changes happen? Well, today we're going to talk about this, but first, let's recap what the first three shocks were. Like, if you don't know what those dates are, we're going to talk about that. I'm going to go back through it pretty quickly. You know that if you watch this channel, you know I love to talk about history. So let's jump back into that time machine. Let's take a trip back, all the way back to the Panic of 1907. Now, we're stopping at a time called the 1907 Bankers Panic. And this was a financial crisis that ended up leading to basically a nationwide collapse of banks. This was in the United States, a nationwide collapse of banks. And the Panic of 1907 and the collapse that happened is partly what helped usher in the establishment of the United States Federal Reserve. Now, I'm not going to go super deep into that, but the bankers had basically been trying to establish a central bank in the United States for quite a long time. It was kind of coming in and going out. Now, there's a book titled The Mystery of Banking by Murray Rothbard. Now, it's a great read. I highly, highly recommend it. And as a matter of fact, in the description of this video, I'm going to link to a free PDF version of the book. It's in the description. It's free. I highly recommend that you download it, read through it, at least skim through it if you want to know anything about what's going on with the banking system. Now, back on track. So after the banking collapse of 1907, we had many Americans that just were completely wiped out financially when the banking system collapsed. Then we had a second major shock. Happened on April 5th, 1933. Anyone know what that date is? 1933. We've talked about it quite a bit on this channel as well. Well, on 1933, April 5th, 1933, President Franklin D. Roosevelt signed an executive order 6102. Does that ring a bell? Anyone? Order 6102. Basically, what Order 6102 is when the U.S. made it illegal for Americans to own gold. They confiscated the gold, and as soon as they took all the gold back, which was money at the time, right? Gold was money. The dollars were backed by gold. Once they took all that back, they revalued it. And what they did is they revalued the gold, which devalued the currency. So immediately, everyone that was holding on to dollars lost 40% of their wealth overnight because they devalued it once they revalued the dollar. Now this, as you can imagine, caused Americans to get completely wiped out. I mean, losing 40% of your money, your purchasing power overnight was devastating for many people. And then that brings us to the third monetary shock, the third and final before we jump to the fourth. The third one, this was on August 15th, 1971. Anyone know this one? I use this date quite a bit. Hopefully you all should know this one. This is when President Richard Nixon severed all ties between the US dollar and gold. And when he did that, he ushered in paper or fiat money, basically the fiat money, the fake money system that we have today. Now, I've talked about many times how this date, 1971, how this shock was the biggest. It was the most destructive of all the shocks that we've seen. And really, since 1971, it's caused all kinds of problems. We've seen real wages go down. We've seen the divide of the rich and poor grow huge. We've seen inflation take off, prices unaffordable, price of gold has shot up, on and on and on. I've referenced before. Again, I highly recommend people to go to the website WTF Happened in 1971 for more. It's just a website full of charts, and you can see everything that's happened since 1971, and I will link to it in the description as well. So just go check that out. Now, this brings us back to what we're talking about today. This is the fourth shock. All right. Now, this fourth shock is happening. I think that we are going to see the end of physical currency altogether. Now, I've talked about going to the digital dollar. I've talked about that before, but I don't think most people are ready for what I would say the new reality for everyone. Anyone who earns, uses, or saves US dollars needs to be ready because this new reality is coming. And it goes pretty deep. There's a lot to unpack here, and there's a lot at stake. I mean, this is the reserve currency of the world, so there's a lot at stake here. Now, I'm going to stick to the most important pieces here, but if you want me to dig in deeper on any of these topics, any of this stuff, like always, leave me a comment down below. Tell me specifically what you'd like me to dig in deeper. I can make additional videos to talk about that. All right, but we're going to try and skim through this a little bit. So the first thing that you must know is that drastic changes, like we just saw in those previous three shocks I mentioned, and the fourth one that's shaping up right now, they're devastating. They're completely devastating for your savings and for your money. And the thing that you have to know is that they happen immediately. They happen without any real warning. It's not like they announce it ahead of time and say, hey, everyone, get ready. We're about to take away half your money. They don't tell you that. They happen really quickly. And so that's why it's so important that we pay attention, right? We see things that are progressing. We see, if you want to say, like how the stars are aligning, so we can be prepared. We can take actions ahead of time. And it's also why I give so much background information in my videos. Now, I see in my comments quite often, people are like, yeah, you talk too much, just get to the point, right? But I want you to understand, and I want you to have the full picture so you can avoid the fallout. And I want you to be able to protect yourself, protect your hard-earned savings. And I want you to be able to have the chance to make, whatever small, simple, strategic investments that you can, because right now we're setting up to have some massive, massive moves. I think some of these moves have the potential to hand us more than 1,000% returns if we do it right. Now, this might sound a little bit far-fetched that physical cash is on its way out. A lot of people maybe won't realize that, but cash has powerful enemies. A lot of people want to get rid of cash. Governments hate it, because they can't trace your transactions. If you or I do a deal in physical cash, they don't know about that. Only you and I know about that, which is the way it should be. But the government doesn't like it. The banks hate it because the banks, it means that you don't have to rely on them to do transactions, right? You don't have to rely on them to earn, to spend, and if you're not relying on them to earn and spend, then they can't skim off profits, right? They can't skim the money off each transaction. The elites, whoever they are, they also want to get rid of cash. Now, one good example is Ken Rogoff. He's a Harvard professor. He's a former International Monetary Fund, the IMF, International Monetary Fund chief economist. And he's the perfect example of what I would call, quote unquote, establishment economist. In 2016, he published a book called The Curse of Cash, which of course from the title of it, sounds like he doesn't like cash, The Curse of Cash. And in it, he argued that the US should basically get rid of all cash, right? He said we need to phase it out of society. We need to get rid of it. He says that cash just helps criminals. Only criminals use cash. It's interesting. I thought people that need to buy things and feed their families use cash too, but I guess we're all criminals. But anyway, he says that only criminals use cash. Only people that want to avoid taxes use cash. Anyway, here's his solution. He said that all paper currency should be phased out. So what you would do is you would start with banknotes of $50 and more. So get rid of the hundreds, get rid of the 50s, and then eventually you work your way down. Next, eventually you get rid of the 20. Eventually you get rid of the 10, and then maybe you're only left with like dollars and fives, and then probably eventually you get rid of those as well. Now, in Rogoff's world, governments run the money system, right? They run it directly. Now, there's no messing around with stealthy cash, no payment options that you can keep private, that you can keep out of view of the government. All of that has to be banned, is what he says. Now, I hate to break this to you, but in many ways, this war on cash that I'm talking about, it's already over. It's already over. Like, it's game, set, match, if you want to say that, checkmate, whatever. Now, in 2016, this is beyond the US. Now, in 2016, India wiped out 86% of its cash overnight. They just basically said, they woke up one day and said, hey, all bills over 500 and 1,000 rupee, all the banknotes over 500 and 1,000, they're no longer valid. So all those people that have a bunch of cash piled up in their house or saved or wherever it is, sorry, your money's no good. Now, they did give them like a really short time to turn that money in before it was worthless. In my opinion, it wasn't really enough time, especially for people in India that maybe didn't have access to the news and things like that. But it's not just India. Australia claims that they want to be cashless by 2022. It's 2 years away. Denmark says they want to be cashless by 2030, 10 years away. Now, Ecuador was the first country to launch a digital currency last year. The EU, the European Union, they're getting rid of their $500 banknotes, or euro notes, I should say. In France and Italy, you're not allowed to do cash transactions over 1,000 euro. Now, in the US, we already have super strict laws as well, what we call capital control laws. They want to control the capital. So, for instance, if you deposit, transfer, or withdraw $10,000 or more, your bank automatically alerts a bureau within the Treasury Department. And basically, they have to file what's known as a currency transaction report. Same thing if you exchange foreign currencies, anything that's $10,000 or more. And the bureau is called the FinCEN, Financial Crimes Enforcement Network, because I guess it's a crime to use more than $10,000. It says it right in the name. Pretty weird, right? And basically, its job is to monitor, analyze, collect all the data on all Americans' financial transactions. Now, you can get in trouble with the feds even if you deposit, transfer, withdraw less than $10,000. As a matter of fact, if you choose lower amounts, you can still get in trouble. If they think you're trying to evade their reporting, then the banks have to report to you. As a matter of fact, they file something called suspicious activity reports, SARS reports, and the banks have quotas. They have to file a certain amount of these. And if they see you withdrawing cash under that and they think that you're trying to evade the report, then that's a felony. It's a felony. They call it structuring. I was trying to find it for this show. I couldn't find it. There was a lawmaker, a legislator, I forget, a couple years ago that got sentenced to this for structuring. If anybody knows, leave it in the comment down below. But basically, for structuring, for pulling out money, your money out of the bank, less than $10,000, it's a felony. You can face a decade in prison for that. Amazing, right? Now, what we have now is we have a massive catalyst, something really accelerating the fourth shock. And if you want to take a guess at what that is, well, if you guess the CV pandemic, you'd probably be right. So the CV pandemic is accelerating this, of course. Accelerating the phase out of physical cash. Maybe you've already seen the signs all around. Lots of places where I live have signs, no cash accepted, credit cards only accepted for payment, things like that. We're starting to see signs about, coin shortages, cash shortages, all these things. And of course, thanks to the pandemic, there's all types of fears now that cash is dirty, cash could hold diseases and all these things. So that's why, we see retailers, coffee shops, restaurants, etc. And they're all saying, nope, we don't want your cash. We don't want it. And so that's probably going to be the final nail in the coffin. Like I said, it's really accelerating this. And you might have heard the old saying, the old government ethos, if you will, the quote unquote, never let a crisis go to waste. Well, that's a perfect analogy for what we're having right here. They're using this pandemic crisis to push their agenda to get rid of cash. A crisis allows them to do lots of things they wouldn't otherwise be able to do. And so they can push for things like getting rid of cash, like they normally wouldn't be able to do that. Now, moving to a digital cashless society it's been on their bucket list for a long time. Like I said, in 2016, that Professor Rogoff was already pushing for that. Countries have already been doing this. But the pandemic, the CV pandemic, the hysteria, the emergency, whatever you want to call it, gives them a perfect opportunity to really push this through. And they're all ready. The central banks, they're already standing by, ready for this to happen. Like I already mentioned, Ecuador was the first to already launch their digital currency. I did a video, I'll link to it right here, where I talked about China's central bank and how they're already launching their own digital currency and how it could be backed by gold. I think more than 2/3 of the world's central banks have already said they're exploring and working on rolling out their own pure digital currency. The Bank of England, they're researching how to create a digital currency linked to Britain's currency, the pound sterling. The Bank of Canada is looking at issuing its own crypto version of the Canadian dollar. Sweden's Riksbank, it's the world's oldest central bank. They're exploring what they call the e-krona. It's a digital-only version of the Swedish krona. We got Japan, we got Singapore, we got Denmark, we got Norway. They're all among countries that are working right now to put out a digital-only replacement for their national currencies. Now, there's a plan in place. The highest levels of the United States, I've talked about this in other videos, where they want to introduce a digital-only dollar payment system. I did a video recently about the showdown that's inevitable, that's happening. Now, in this new system, the Fed will be able to simply just credit people's account, right? Your Fed account, and they'll just put their Fed coin right into your Fed account digitally. And it would really help getting the stimulus money out to people, right? However, if they can just put money in your account, they can also delete money out of your account. Not only can they delete money out of your account, they can monitor everything that you're doing financially, approve what you can do, disapprove what you can do, block it, etc. Now, look, I'm not trying to scare you any more than you might already be. I know people's stress levels and fear levels are sky high. The CV pandemic is definitely doing that, and it's created a lot of market turbulence. We don't know what we're going to do for jobs, what we're going to do for money. We don't know what's going to happen with the markets. We don't know anything right now. And a lot of people are deeply confused, and I get that. All right. Now, some people are even more paralyzed by this because not only are they confused, but they don't know what to do. But I just want to let you know that in times of profound change like this, the most lucrative wealth building opportunities are around. All right. When there's times of change, when people are moving, people get scared, but this is the time. This is where the opportunities are. Now, you might be asking yourself, where are those opportunities? Well, Those opportunities are going to be in places where you already hold your wealth. Now, but where do you hold your wealth outside of your dollars, outside of your currency, outside of your country's paper fiat dollars? And as people start to realize this and start to flood into these other areas to put your money, then it's going to continue to push those up. So not only will you be protecting your wealth, it's also going to be increasing because the demand's going up. It's always supply and demand, always supply and demand. So as the dollar's value go down, these other areas will be going up based off supply and demand. Now, what do I have in mind? Well, again, if you're no strangers to the channel, you probably already know what I'm talking about. Of course, my favorites, gold and Bitcoin, come to mind for me. Gold's been money for 5,000 years. Just yesterday, I think it got back to its new all-time high, and it has smooth sailing, clear skies, as we say, and I expect it to do really, really well. It has a long way to go. Of course, my favorite, a little bit riskier bet, but has way more upside, is Bitcoin. Now, Bitcoin also just crossed a key level just yesterday. It got over $10,000. It's a very, very key level. And we've seen it jump from 10,000 to 20,000 in like 18 days. It can happen again. So it's more risky, more risk, more reward, right? Now, the thing that I want you to take away from this fourth shock that's coming is that history shows us that when these changes come, these massive changes to the monetary system, people get crushed. All right. Now, this is not a prediction. This is what history shows us. We've connected the dots. This is what it's saying. The wheels are already in motion. This is happening. The only question is, are you prepared? That's the only question. So let me know. Leave me a comment down below. Let me know, are you prepared? Do you see the dots connected? Are you prepared for the end of the dollar or for this new digital dollar that's controlled? Leave me a comment, yes or no. Let me know. Give me a thumbs up on this video if you like it. If you don't like this video, give me a thumbs down. Either way, it's okay. Let me know. I always want to hear from you. I try to answer every comment, but now I'm getting so many comments that I find it hard. So the first day or two, I'll try and answer all your comments. All right, leave me a comment, give me a thumbs up on this video, and that's it. To your success.
There you have it, folks. I hope it was very informative. And of course, his view, how he's protecting it is gold. He prefer gold and Bitcoin. Of course, everyone have their own preference. I'm not necessarily would recommend Bitcoin and so forth, but everyone have their preference, of course. In our case in Samaritan, a lot of persons have turned to farming and agriculture, which is very good. Because at the end of the day, the basics always are important. If the prices of those basics shoot through the roof, and you got it in your backyard, there's nothing for you to fear. If worst case scenario, the price of oil shoots through the roof, and you have invested in solar panels and so forth, you won't have that much to worry about. If you invested in different currencies, like especially those who are on the forex. Most people use it for speculation, but forex exchange is not only for speculation. You can also decide to have different currencies in different countries, so British pounds, and you hold it in different currencies. That if one goes up, one goes down, or whatever, you hedge yourself against that. You can also invest in silver and gold. My preference is just to have a diversification of all these things, because it allows you to be very diversified. So you're not really relying on any one thing, because you just don't know which direction things are going to go. So in my opinion, is if you can dab into a little bit of everything, and if you want to concentrate more on something, one of them you can, but still have exposure to various different things, then to me that's the best bang for the buck. The scripture even says that life is so uncertain. So it says, cast your grains across the seas, and in time profits will flow back to you, but divide your investments among many places, for you do not know what risk may come upon the earth. So in that sense, the more diversified you are outside of your country, within your country, into different aspects of, in this case, farming, renewable energy, or whatever, the better you will be. I call it building up your financial ark, just like the analogy of Noah and the ark. If you prepare for the worst of times, you'll always know good times, and that has always been my philosophy. So when there has always been good times for me, I always put aside as if there's a famine coming, and that allows me to always have a neutral ground, whether in good or bad times. But everyone is different. Everyone has a different objective, so what will work for me might not work for you, and so forth. Nonetheless, I hope it was a very informative program. I'm glad to bring it for you. So next week, hopefully, if the gentleman is able to come online, we'll have an interesting discussion about the Netherlands. If not, I'll just bring you another informative program as well. I might touch on, if the gentleman does not come on, I might touch on the differences between crypto currencies, credit clearing, and the current fiat system that we use, and give a clash between them, and show that the pros and cons of each one of them. So nonetheless, I want to thank you for listening, and I'll see you next week in another informative program. Bye-bye.
I've come here to discuss something personal to me, my orange juice. See, I only drink Florida's Natural brand premium, not from concentrate orange juice. I know the folks at Florida Natural do things a little differently from the big juice companies. They own the land, the trees, and the company. They're a co-op of Florida growers whose only business is making juices, and that's why their juice tastes so good. So have a cold glass of Florida's Natural orange juice made from their own fresh oranges. It's as close to the grove as you can get. It's made from Florida oranges. Florida Natural juices are exclusively distributed by Prime Distributors.